Many traders think that simply drawing a trend line is enough to understand the market. But in reality, this is one of the most misused tools in technical analysis. If you've ever been confident with a trend line only to see the price completely break through it, this video will help you change your perspective on the market. Today, we'll go straight to the 4 most important strategies with trend lines: crossovers, strong breakouts, golden retests, and trendline bounces. And finally, there will be an extremely simple summary matrix to help you know exactly which strategy to use in each market situation. Okay, let's get to part 1, the trendline trap. Let's be honest, are your trend lines just random lines drawn on the chart? The reality is that trend lines are everywhere, but they are rarely used effectively. Most traders lose money not because the trend line itself is broken, but because they simply don't know how to confirm their trading setup. They just enter trades blindly and hope the trend line will hold. But if you just connect points without any strict rules for entry, confirmation, and risk, you're not really analyzing the market, you're just drawing. And drawing without rules will lead straight to trades with a low probability of success. So, to ensure we fully understand the same thing, a trend line is basically exactly what its name suggests, a line drawn on a chart connecting important peaks or troughs to show us the direction of the market. It's a great visual representation of structure, but as we're about to see, the trend line itself is just the first step. Let's look at our first tool, our first strategy, the crossover. This first setup is specifically designed to safely capture trend reversal points, giving you another layer of solid mathematical confirmation before you risk any money. To see how this works, we'll look at a real-world example from the source, the USD CAD pair against the Canadian dollar, on a fast 5-minute chart. This particular pair perfectly illustrates the accuracy of these setups on major Forex markets. So, how do you do this? First, you patiently wait for a 5-minute candle to break the trend line. Second, you observe the 2-1 period simple moving average crossing the 5-0 period simple moving average. But this is an extremely important point to remember. Those moving averages are only used for confirmation after the breakout has occurred. Absolutely never trade based on the crossover blindly. Finally, the third step is to zoom down the chart to the 1-hour chart to confirm that there has been increased liquidity. This demonstrates that momentum on the higher time frame is supporting your 5-minute trade. And obviously, you can't trade this without solid risk management. The rule here is incredibly simple. You enter the trade when the second breakout candle closes. You place your stop-loss order right behind the most recent high or low, and target the next key resistance level, making sure you're aiming for a profit-risk ratio of at least 2 to 1. You risk 1% to gain 2%. It's that simple. Next is the second strategy, the strong breakout. So, what do you do when the crossover strategy is too slow? Sometimes waiting for moving averages means you miss the entire rally. That brings us to the next example, gold or XAUUSD, on a 5-minute chart. Gold is notoriously volatile. It moves very fast. If you wait for the crossover here, the trade is probably already over. A strong breakout is the optimal solution to catch early reversals without relying on lagging indicators. But remember, aggressive entry doesn't mean reckless entry. To avoid being fooled by false breakouts in a fast market, you need strong structural confirmation. Since you're not using moving averages, you're looking for double rejection patterns, like double tops or double bottoms that show momentum is fading. You want to actually see a structural breakout in price. And again, you zoom the chart down to the 1-hour time frame to check for order, stock, or liquidity being pushed out, deliberately holding back buyers or sellers right before the breakout. Okay, third strategy, retest the golden level. While the aggressive breakout focuses on capturing the initial burst, this next tool focuses entirely on highly accurate downward corrections that occur right after a major breakout. We're back to the USD CAD pair on the 5-minute chart here. And frankly, the fact that 2 completely different strategies work effectively on the same currency pair proves you don't need to monitor 50 different markets. You just need to know exactly which setups you're looking for. The magic of this strategy really lies in 2 very specific numbers, the gold Fibonacci retracement levels. The Fibonacci zone lies between 50% and 61.8%. For this setup to be truly valid, that strong breakout needs to correct downwards and be precisely rejected at these Fibonacci levels. This isn't just a regular trendline retest. It's a perfectly coinciding retest of this mathematical golden zone. Here's the strategy. First, identify that strong breakout candle. Second, draw your Fibonacci tool from beginning to end of the movement. Third, you patiently wait. Wait for the price to correct downwards and be strongly rejected right inside that golden zone. And fourth, do we notice a trend here? You confirm that this setup perfectly aligns with the 1-hour trend. Aligning with a higher time frame is essential. And that brings us to the fourth strategy, the trendline bounce. Everything we've discussed so far has been about catching trend reversals, but let's move on to trend following setups. This allows you to follow an established trend instead of trying to predict the exact reversal point. And the psychology behind this bounce is interesting. You draw your trend line and wait for the price to touch it. But here's the real secret. You actually want to see a trap. You want the price to break the trend line momentarily. Why? Because it triggers the stop-loss orders of retail traders and tricks everyone into trading the breakout trend. That's the liquidity wipeout. As soon as institutional money gets hold of that liquidity, the market bounces back. You jump in as soon as you see a strong rejection candle, such as a bullish engulfing candle or a bearish pin bar, and you follow that main trend. Okay, part 6. Let's summarize all of this in our summary. This is the ultimate summary. Analyze this matrix so you know exactly which strategy to use in different market conditions. First, if you want safety and reversals, your core advantage is the crossover. Your primary confirmation is the crossover of the 21 and 50 SMA lines, along with a 1-hour liquidity sweep, perfect for currency pairs like USD, CAD. But if the market is moving super fast, as we've seen with gold, your choice is a strong breakout to catch early reversals, relying on double tops or bottoms to confirm the structure. Next, if you're looking for highly accurate entry points after a move has already taken place, you need a retest of gold, confirmed by the 50% and 61.8 Fibonacci levels. And finally, if you just want to trade the main trend, use the trendline bounce. The key confirmation there is waiting for a false liquidity sweep, followed by a strong pin candle. 4 different tools, 4 different advantages, perfectly suited to different conditions. And I really want to end with this great quote from the original source. The key to success is not constantly changing strategies, but mastering a setup and applying it with discipline. You don't need to try trading all 4 tools today. You just need to choose one that suits your personal trading style and perfect it. So, based on the summary matrix we just looked at, which tool will you master first? Will you be a patient crossover trader or a bold, dynamic breakout trader first? Choose one, test it thoroughly, and create that technical advantage for yourself. Thank you very much for joining us for this explanation today.